Welcome everyone to our presentation. For those that didn't catch me last time, my name is Andre, one of the senior wealth advisors here with Oreana Private Wealth. Happy to have you all here with us. As part of our webinar series for this year, the topic for this evening is repatriation strategies for Australian expatriates. This will be presented by my colleague, Matthew Jones, who I will introduce shortly. But a few housekeeping issues, Matt, if you want to go to that slide. It's with regards to the setting. So everyone will be muted during the webinar. I hope you don't mind. However, if you have any questions and questions, please use the Q&A button for the questions you'd like us to have a look at, and time permitting, we'll attend to them at the end of the presentation. Again, chatting among attendees will also be switched off, so we have a better attendee experience for that. That's about it in terms of the housekeeping, if you like. So now I'd like to introduce the speaker for tonight, which is my colleague, Matthew Jones. Matthew is a senior wealth advisor at Oreana Private Wealth. He's been in the financial advice industry for more than 10 years. The pertinent point is he is licensed in Australia and also in Hong Kong, which is quite a big feat, being able to be authorized and operating in those two jurisdictions. Matty specializes in delivering comprehensive financial advice for expatriates through Asia and clients returning to Australia. And he's in a unique position to do so because of his dual licensing ability. The areas that he specializes in includes and not limited to wealth creation, insurance, tax planning, superannuation, and retirement planning as well. And the other part of with working with Matthew is that he is overall a really good guy, and he's really attentive to what your requirements are, and will be explaining any type of topics in a very matter of fact and simple way that you'll be able to understand. So a very good person to engage with in this type of discussion. Prior to joining Oreana, Matthew came from an independently licensed wealth management firm in Sydney, where he was working with wealth creation advice for high net worth clients and family offices. So he's very familiar with a lot of the topics that impacts on people such as expatriates and the issues relating to all that. Added to the fact that he used to work as a technical analyst with Macquarie Bank, where he provided technical advice to financial advice across Australia. So along with the other senior wealth advisors that we have in our business, he is very well qualified and licensed to really be having a good conversation about your situation and how we can actually be of assistance. And so without any further ado, I'll hand over to Matt to start his presentation.
Thanks, Andre. Thanks everyone for joining, seeing some familiar names on there coming through now. So as I'm sure you're all aware, a case for many of you that have joined today, working abroad, whether that be in Hong Kong or elsewhere, offers some great opportunities. This may be around improved employment opportunities, increased packages, earning capacity, lower tax, and overall good opportunities to improve your well-being for you and your family. So this evening, we're going to discuss a couple of points. Some of the areas we often address with Australians living abroad from a financial planning perspective. We're going to discuss some of the issues expatriates can face when moving back to Australia. We're lucky enough tonight to have Gavin Herman, a good friend of mine, join us to discuss his experience of relocating back to Australia recently. And also we have our friends from SendFX joining us this evening with Ian Craig here to discuss how they can assist with currency transfers, including an insight into the Aussie dollar and the US dollar. We're then going to go through some of the key strategy considerations for repatriating back to Australia, particularly on how to mitigate your potential tax implications. Finally, we'll open it up for some Q&A at the end. As Andre mentioned, just put your questions into the Q&A box and we'll come back to those. So some things to think about as expats living abroad, having goals and appropriate financial plans. One of the first things as advisors we do whenever we sit in front of a client is to ask, what are your goals? It's important to have clear and defined goals to ensure that your time spent abroad is valuable. It may sound somewhat trivial, however, it is important that your goals are identified and financially quantifiable. Sometimes this is more difficult than it sounds, particularly for expats when it's often uncertain how long you may be living abroad. Documenting these goals is an effective step towards achieving them. Planning ahead and making sure you have a strategy in place to achieve these targets, and making sure you regularly review how you're tracking towards achieving your goals. So understanding your tax residency and obligations. Which country are you currently a tax resident? So generally speaking, you're a tax resident where you're living. However, with the challenges that COVID has presented obviously recently, it is important to ensure that you are certain of your tax residency, particularly if you have been moving between countries or find yourself stuck in a country for an extended period of time. The criteria for residency for tax purposes varies from jurisdiction to jurisdiction, although there are generally a couple of common tests. The first one is physical presence. So often there's a majority of days per year rule for assessing residence. For instance, remaining in a country for greater than 180 days during a year is often a common test. Or on average spending more than 90 days per year in a particular country, on average may deem your residency for tax purposes. So just being aware of those. Permanent home. So when assessing whether a country is your current home or permanent place of abode, considerations may be given to a number of factors. This may include, but not limited to, your employment, and ownership of a house, current fixed term leases, utility bills, active bank accounts, through to family interests such as where your partner and children may be living. And also just being aware of the nomad rule, again, quite common these days with COVID. A tax nomad is where a person finds themselves to not be a tax resident of any country, or at least not paying tax in a particular country at any given time. This has obviously been common with people being displaced globally or working via distance. So while at first glance this sounds somewhat appealing, that you may be slipping through the tax net, often becoming a tax nomad may revert your tax residency to your country of domicile. For Aussies, this can mean being assessed under Australian marginal tax rates and subject to worldwide income assessment. So as an Australian tax resident, most of us will be familiar with the marginal tax rates up to 45% plus Medicare levy. This includes for employment income, but also for investment income and capital gains. Tax is also applied to worldwide income as an Australian tax resident on assets outside of Australia. So living in Hong Kong and most countries within Asia, we are lucky enough to benefit from lower tax rates and often an exemption on the tax on capital gains on investments, as is the case for Hong Kong. However, it is important to understand that Australian tax may still apply for non-residents, Australians living abroad, on Australian sourced real property income. So basically rental on a property in Australia. This can be taxed at non-resident rates on the right here of this screen. So Australian property and managing your debt as an expat. Tax deductible debt. So not often investors purchase property straight out with cash, and therefore there'll be an associated debt or mortgage against the property. There are two types of debt. There's personal debt, and this is typically associated with your home. This is non-deductible for tax purposes and should usually be paid down as soon as possible. And then there's deductible debt for investment purposes. For instance, if you have a debt related to a property you're using to generate rental income, or this may be through the means of Airbnb, you may be able to claim the interest as a deduction to offset your taxable income, thereby reducing the tax you pay on the overall tax bill. When it comes to deductible debt and offsetting taxable income, there is both positive and negative gearing, which is the associated borrowing levels. The following slides will explain the two different approaches, along with tax on the sale of property as a current non-resident. So positive gearing occurs when you receive more in rental income than what you pay on the likes of loan interest, property maintenance, management fees, rates, and other deductible expenses. This may also be where rental income may be particularly high due to strong demand or for rental property or low interest rates, such as the environment we're in right now. So here we have rental income at $60,000 per annum in this example. The deductible expenses are totaling $30,000, leaving you a net rental of $30,000, which is taxable at non-resident rates if you're living abroad. So based on this example, if you had no other tax credits, you'd pay non-resident tax rates at 32.5% on the first dollar of income. On this 30,000, that would equate to 9,750. A strategy to reduce this tax may be to make personal concessional contributions to superannuation, a strategy we'll get to later in these slides. Negative gearing. Negative gearing occurs where the rental income received is less than the total costs or deductible expenses involved in owning that investment property. In this example, same income. However, the net expenses are higher. This may be driven by a higher associated debt, for instance, and the cost of that loan. In Australia, these tax losses may be used to offset other Australian income, such as your employment income. However, living offshore, you are able to accrue these net income losses each year as carry forward tax credits. Now, these carry forward credits can be used to offset either potential capital gains on the future sale of the property or income when you return to Australia, including your employment income following repatriation. Selling a property, some key points here. So as you can see here, as an Australian tax resident, most of you will be familiar that selling your home is fully exempt from any capital gains tax. And selling an investment property, the capital gain is first discounted at 50%, with the discounted capital gain then being taxed at your current marginal tax rate. However, for non-residents, for tax purposes, if you sell your home while living overseas, you'll actually be taxed on the full capital gain at non-resident rates. This is also the same for any investment property. Now, previously, Australians moving abroad could actually continue to claim their home as their principal residence and could claim the full exemption on CGT for up to 7 years. This exemption has actually since been abolished since June last year. So with these current or recent rule changes in effect, it is important to consider when the best time may be to sell your home. Often I would say it's following your repatriation back to Australia, particularly if it is within that 7-year period, as you can then still continue to claim it as your home again. However, for those who have been caught out or invested in property, thankfully there are some strategies that are utilised to offset some of these taxable gains, which we'll come back to shortly. Now, finally, just again, important points that we address as advisors quite often with expats. Risk protection. Do you have adequate personal insurance to provide for you and your family in the case of an unexpected illness or accident? Further to this, does your existing insurance cover continue to remain appropriate following your relocation outside of Australia. Quite often, Australian insurers have territorial exclusions on disability cover for Australians living abroad. This can potentially preclude claiming your full insurance benefit in the event of a claim while living overseas. It's therefore very important to ensure that you have the right cover in place to ensure you're both protected and also not paying premiums for ineffective cover. From an estate planning perspective, if you have assets in multiple jurisdictions, is your Australian will sufficient? Depending on the complexity of your financial affairs, it is important to consider reviewing your will. Often it is the case that it may be the case where you have separate wills addressing the assets in each of these countries. Further to this, while your will deals with physical assets, an estate plan considers your total wealth, including your superannuation, which is actually dealt outside of your will, guardianship, business interests, and who will control your care and finances should you lose mental capacity. The best way to understand risk protection and estate planning needs is to speak to an advisor. So we've just got a poll here that we're going to run, an interactive poll. If you could bring that up for us, Andre. If everyone can see that. So here it's just a poll. It's just multiple choice. If you can select one. The biggest concern with regards to repatriating back to Australia, that's meant to say. So here we have currency concerns. So obviously the Aussie dollar, when and how to move your money back to Australia. Tax, so tax on assets when it comes time to repatriate. Investments, what to do with your current investments and the strategy moving forward. Or cash flow, managing your budget and expenses, including having a budget for unexpected expenses as well. So yeah, if everyone can just select one of those. Now, just in the meantime, while we've got that poll running in the background, I'm just going to throw to Gavin Herman, who's been kind enough to join us this evening to discuss his recent experience in repatriating back to Australia. Gav, over to you.
Thanks, Matt. Good evening, everyone. Hope you can all hear me. Yeah, it was interesting just hearing some of Matt's slides there, because I think I'm probably one of those people that, left Australia. I actually left Australia 16 years ago, and Matt's right. You sort of never know when exactly you're going to come home, and it's not until you're in that situation that you suddenly start thinking about some of these issues. So yeah, a lot of those things hit home for me. Just a bit about my background. So I've been in, banking roles. I moved to Tokyo 16 years ago. I was only there for about 1.5 years. And then I moved to Singapore. I was there for about 7.5 years. And the final 7 years I spent in Hong Kong. So, fortunate enough to meet Matt in recent years in Hong Kong. I think there's a few other people on the call that I may be familiar with as well. So hello to all those guys. So I officially came back to Australia in November. So my role was made redundant, my last banking role while I was living in Hong Kong. I was pretty fortunate. I had a bit of a heads up. So I kind of knew in second quarter that my role would end. And I was on gardening leave, I think, from about June. So I ended up doing a little bit of back and forth between Sydney and Hong Kong. I came back to Sydney in June, did 2 weeks quarantine, was here for a couple of months. I bought a property while I was back here, and sort of started getting that set up. I had to go back to Hong Kong for a couple of months in September, did another 2 weeks quarantine, and I sort of finalized my affairs there. Some of the things I guess I was thinking about, during this time, obviously simple things like moving company. I sort of, had to make a call on whether to keep my super or my pension in Hong Kong or not. I'd also started one of those sort of investment plans, I guess, which a lot of, I guess, guys, expats, especially in Singapore and Hong Kong, are exposed to some of these offshore investment plans. So I've got one of those as well. So, you sort of start thinking about those, as Matt mentioned, some of the tax implications of them, and also, whether it was a good idea. I guess for me, I was quite fortunate. Aussie dollar at that time was sort of around 70 cents. So I kind of thought it was a good idea. So I, in the end, decided to encash my my Hong Kong pension and bring it back to Australia. But as everyone's probably aware, that money doesn't hit your account until you've actually, done your final tax statement there in Hong Kong. And so really, I didn't really get those funds until sort of end of November. But it was a decision that I really had to make, sort of back in sort of August, September. So, and then, as Matt mentioned, now that I'm here, things like, okay, so what's my new taxation? What timing am I now an Australian tax resident? What do I have to think about? I personally have some ongoing, payments that are coming into my Hong Kong bank account that I have to now declare in Australia. So, as Matt alluded to, there's a lot of, potential complications, I think, that you have to sort of sit down and get the right advice to, to work out, what is the best strategy for the individual. So, I fully support what Matt said in terms of, you've definitely got to sit down and have a bit of a plan and be really clear, I think, on, how you want your affairs to be. If you're going repatriating, expatriating back to Australia, where you want your cash to remain, and what all the tax implications are of that. And of course, there's currency concerns around that as well. So I definitely encourage you all to sort of, have a think about it if you think it's a situation you're going to be in soon. Definitely, from my point of view, a lot of friends I've known over the years and ex-colleagues are all probably in a situation where they're thinking about returning home. Maybe it might be their own choice of timing, which mine wasn't. But I think a lot of people their lives are getting more complicated because of quarantine and kids maybe at boarding school and stuff. So I think there's other concerns that people are thinking about these days. Certainly for me, so as I sort of alluded to, I actually started sending some money back to Australia when the Aussie dollar was sort of around 70 cents. I guess for me, the whole cross-border FX conversion, being from the banking side, I obviously understand how it all works, but at the same time, it can be tough to find a bank that's willing to give you rates that are sort of, comparable to the real wholesale market. So, for me, I ended up getting involved in the guys at Send after I got back to Australia, just because, I just find that some of these providers, and especially like Send, they're making a name in this space because they're disrupting, the traditional business of the banks. And banks generally provide, very, very nice prices to wholesale clients. But when it comes to sort of retail individuals is mostly where they start, their pricing becomes a bit less competitive, and because it's generally business that they've, it's been quite sticky for them, and they've been able to, to make some good margin on retail business. But I really think that if an individual is willing to shop around, that, there's people such as SendFX, which you'll hear from me in a moment, who are, disrupting this space and making it more competitive. And there's more opportunity, I think, for individuals to find more competitive FX rates if they're willing to do a little bit of homework. So, I definitely would suggest and recommend that people do their homework. For me, I sort of ended up converting money back in sort of incremental amounts. So I didn't ever do sort of one big lump sum. I mean, for me, that was partly because, as everyone probably is aware, the banking industry, it's a bit more difficult to do one big lump sum amount. I mean, you can, but I was sort of more comfortable doing it in incremental amounts, and I'd sort of take advantage when Aussie dollar was a bit lower and do another sort of small clip. I sort of did it in that process. And like I said that just before, for me now, probably when I first left Hong Kong, my issues, that I was thinking about was sort of managing cash flow and how my expenses would go, you know, when I was coming back to Australia and trying to sort of, you know, restart my life here. But as time goes on, I guess as we're getting towards the end of the Australian financial year, I'm definitely now sort of turning my thoughts are turning more to sort of the tax issues. And yeah, so I'm sort of starting those conversations and starting to get my affairs together to make sure that I'm going to be ready and prepared for, you know, the Australian tax year, which is coming up. I should mention, I was also one of the, I know probably some people are aware that you can do a you know, sort of a one-off contribution to your Australian super. So I definitely did that. I think 2 or 3 years ago. Matt will probably correct me, but it was an amount. I think you could do 160,000 a year at one stage, and then they reduced that to 100,000 a year, and you're allowed to do 3 years up front. So you know, I actually didn't end up doing it a few months ago, but I did some about 2 or 3 years ago. And it was a consideration that I did consider putting a lump into my Australian super on return, but I haven't done it thus far. So I probably have missed that boat. But I think that's something else, as Matt suggested before, that people have to consider. You know, if you're considering as an Aussie, you know, expat returning to Australia, I think it can be a good opportunity to put a lump sum in your Australian super if that is suitable for people. So
yeah, we'll come back to that, Gav.
Sure. Cheers. That's all from me.
Cool. All right. Thanks. That was interesting. Just Andre, if you want to bring up I think we can bring up the poll results. Right. So yeah, it looks like tax issues are the big one there, followed by currency and investments. All right. So that'll segue nicely into the next section. So we've got Ian here. So Ian, he joins us today from SendFX. Send have been supporting Oreana's clients when it comes to assisting with currency transfers, not only for Australia, but for currencies around the globe. Ian, I'll hand over to you.
Thank you very much, Matt, Andre. Appreciate the opportunity to come and speak, and good evening, everybody. Yeah, so to give you a bit of an insight, really, it's interesting to see those figures come in. I was expecting to actually be a bit higher than that in terms of currency, and perhaps we hear some of the stats, or some of my outlook, perhaps you might think about it a bit more. The cast your eyes back to 12 months ago, actually, bang on 12 months ago last week. The Hong Kong dollar was sitting at an all-time high against the Australian dollar. So it was significant, well, a great time for any expat then in Hong Kong to transfer money back. Cast your eyes forward 12 months to where we are today, and the Aussie dollar has pulled back almost about 30%. So yes, it's seen significant gains. The Aussie dollar, so puts people in Hong Kong, unfortunately, in a slightly worse situation to bring their funds back. I'll give you a bit of introduction in terms of who I am. So yeah, excuse the glarish pink. It's part of our new branding. 13 years experience across the UK and Australian foreign exchange payments markets. Send are a fintech company based in Australia. We assist individuals and businesses with cross-border payments, providing better pricing than the traditional banks, but also a much more kind of concierge service with faster, cheaper payments than the banks. We can get your money from A to B a lot quicker with better technology as well. We primarily look after and work with companies like Oreana and a number of financial institutions, both in Australia and overseas, working with kind of high net worth expat C-suite professionals throughout the Asia Pacific. Fully regulated here in ASIC, by ASIC and AUSTRAC as well. So Matt, that's going to give you a bit of an outlook really in terms of where we believe, and full disclaimer, this is personal advice, general advice, not personal advice. I just start throwing it out there. Where do we see the Aussie and the US in the coming months? Well, for me personally, I think that what could affect the AED positively, vaccine successes, the ease of border restrictions, and I think upbeat economic data from Australia coming out would do very, very well for the AED. What could affect it negatively against the US dollar? COVID outbreaks throughout Australia, a third wave perhaps across the global scene, but also trade tensions as well, and obviously export bans, which if you've been following the the news is a big thing which is having a big impact here on some of Australia's biggest commodities. As we know, Australia is a commodity-driven currency, the dollar is. So as long as that goes in favour of the Australian dollar, then I think we'll see the Australian dollar rise from that there. Short term, how do we see it? I'd say it's going to be trading lower around the same for the time being. But the strong economic data from the US could also pull the US dollar in a stronger favour. So my details are there. I'd encourage anybody to take note of those there. By all means, I don't want to steal, obviously, Matt and Andre's fund today whatsoever. But if you want to, feel free to contact me directly. As I said, we do assist clients around the world, not just in Hong Kong, but also like kind of Singapore, Japan. So any expats in Asia Pacific who are transferring funds to or from Australia back and forth, we can assist. As I said, as Gavin experienced himself firsthand, providing you with a much better return. So for any kind of transactions from a few $1,000s into the millions of dollars, be it from a house sale, pension transfers, inheritance transfers, sending funds to family, these are all reasons where we can assist and ensure you get a much better return on your transactions using our services against the traditional banks. And it's been a pleasure so far working with Matt and Andre and a number of their clients, assisting them with their transactions back and forth. And happy to answer any questions that anyone has, either online or please note my details and we can discuss afterwards.
All right, thanks, Anne. Yeah, I think we've got a question come through already around the Aussie, so we'll come back to that at the end.
Yeah, great.
Thanks, Anne. Yeah, like Anne said, I've seen some good success with clients that Ian's helped. It's quite often, I don't think I've seen him not beat the banks on the rate so far. So thanks for coming on and having a chat. So as we move into the second half here tonight, tax considerations on investments. As we move further here, you can see that tax for expats that was concerning everyone on the polls. When it comes to the strategies for dealing with the various investment assets, the strategies do vary. The main groups here we'll address tonight are liquid investments, so stocks, managed funds, bonds and fixed interest investments, property and real estate, and alternative investments, which are often illiquid and cannot be sold easily. So these may include private equity, art, wine portfolios, collectibles, and those of that nature. So the first strategy that we're going to look at here is superannuation. So superannuation has its own specific tax environment. Investment returns within superannuation are concessionally taxed at 15%, and discounted capital gains are at 10%. So further to this, at retirement, you can actually switch your superannuation from accumulation phase to what we refer to as pension phase, which not only provides a tax-free income stream, but also all returns within superannuation are then tax-free for the rest of your lifetime. This can provide considerable tax efficiencies over time for structuring your wealth. Further to this, there are also tax deductions available on the contributions into superannuation, as well as the ability to move large amounts of wealth into super as after-tax contributions. This can be an effective strategy, particularly for expats coming home after accumulating wealth offshore, which we'll look at now. Okay, so non-concessional or after-tax contributions. Non-concessionals, as mentioned, are after-tax contributions. These do not incur any contribution tax upon entry into super, nor do they receive any tax deductions personally. It's effectively a contribution strategy to move large amounts of your wealth into super, to structure your assets and invest more tax efficiently compared to being at your marginal Australian tax rate. These contributions are capped at 100,000 per annum, as Gav mentioned earlier. However, you do have the ability to trigger the bring forward provision. This allows an individual to contribute up to 300,000 in any single year by using the future caps of the following 2 years. So you can utilise this strategy up to your 65th birthday. And it's important to note that you can only contribute up to the total super balance of 1.6 million. But for expats returning home, particularly, used at the right time, this can be a useful strategy to invest wealth more tax effectively. Oops. I think I'm on the right one there. Concessional contributions. So concessional contributions are the second type of super contributions that we'll talk about tonight. These are tax deductible and allow you to use tax credits similar to that of the tax deductible expenses we spoke about earlier. There's an annual cap of 25,000 per annum. But in Australia, your superannuation guarantee employer contributions are included in this cap. So these employer super contributions that form part of your employment package in Australia. So this often takes up a large amount of this available cap. However, as an expat being employed in another country by a non-Australian employer, you quite often won't be receiving employer super contributions, and therefore you'll have the whole 25,000 cap available. Therefore, the deductible contributions can be useful to offset Australian taxable income that you might have, i.e. your Aussie rental while you're a non-resident. Now, from the 1st of July 2018, a concessional catch-up contribution allowance was implemented by the Australian government. This was effectively to allow people with balances of less than 500,000 who had maybe not salary sacrificed up to their limit to go back and utilise any unused cap from previous years up to a maximum of 5 years. This has actually presented a unique opportunity for expats that are living overseas and have not been receiving employer contributions or actively contributing to their superannuation through concessional contributions. And this unused cap can be accumulated over several years, which can then be triggered later in a single year, for instance. This can be a useful strategy for those repatriating to obtain potentially a large deduction to offset either employment income upon moving back to Australia, or to maximise the deductions of a taxable capital gain event if you were to sell a property. The next one here, so sort of rehashing what we spoke about earlier. As mentioned, previous tax credits can accrue in previous financial years and can be carried forward to offset future Australian taxable gains, including capital gains. Carry forward losses can be maximised in any given year through strategies such as negative gearing, claiming those losses as depreciation and other eligible deductions, as we covered. So holding a property over a number of years, you can accumulate these losses to offset the gain at the eventual sale. Here in the example, you can see how the tax credits have been accrued over multiple years here, effectively reducing the capital gain, taxable capital gain on sale. As you can see here, the results, the strategy of maximising both carry forward losses, in addition to triggering and applying eligible catch-up concessional contributions, you may be able to potentially decrease your capital gains significantly at such time as the sale of a property, while in this example, as you are a foreign resident. From combining the two strategies in the two previous examples, utilising these losses and triggering the bring forward gains, you can basically look at reducing the overall sale quite considerably. In this example, saving upwards of $40,000 in tax. All right, so moving away from superannuation, there are some offshoring strategies that can be utilised. So keeping it high level, there are a couple that we'll talk about tonight. These are offshore strategies, but have private ATO rulings for specific tax treatment for repatriating Australians. And the two main ones we'll talk to are offshore portfolio bonds and international pension funds. So the first one, a portfolio bond, is an investment wrapper type structure which is held offshore, combining a simple life assurance contract to create a highly tax efficient holding vehicle for your investment assets. These investment portfolios are regarded as life insurance policies for Australian income tax purposes, and therefore provide a tax efficient environment for structuring investment assets. Portfolio bonds can offer investment options such as cash, fixed interest, stocks, multiple mutual funds, and a range of diversified investment options. These products are designed to be held for 10 years due to the specific tax treatment under Australian income tax purposes. Now, typically there's two common strategies. The first being probably the most common, I would say, making a one-off contribution, which might either be cash or existing assets that are in specie transferred into the wrapper, which might be stocks, example. The returns within the product are then tax deferred until later years, 10 years specifically, at which point the capital and the accumulated returns within the portfolio can be taken completely tax-free. The second strategy is where you may wish to start the 10-year clock earlier by making regular contributions over time to build the portfolio. There are strict mandates, though, around the contribution amounts, which your advisor can assist you with. Again, accessing the tax-free, the returns tax-free after 10 years. The next one here is international pension funds or foreign super. The strategy here is often useful for high net worth clients who have either already maximised their contributions into superannuation in Australia, or may have a range of alternative assets such as private equity and some of those assets, more alternative assets that may not be suitable for a portfolio bond. Again, just keeping it very high level, some of the benefits include uncapped contributions, open architecture in terms of the assets that can be included, such as your investment in Lombok or some of the more alternative investments such as art and wine, that sort of stuff. As mentioned, they're usually suitable for expats or migrating individuals to Australia and high net worth clients. Withdrawals can be taken from age 55, and returns within the fund are not subject to Australian tax. Initial capital can be withdrawn tax-free, which often means no tax to be paid, or it can be managed quite tax effectively. And there are a various range of estate planning benefits as well. So finally, just wrapping up here. So what sets Oreana apart? We're independent. So Oreana, we're unaligned with any bank or institution. This means that we're able to deliver an unconflicted financial advice proposition to our clients. Holistic, client focused. We offer high quality and bespoke strategic advice to our clients, encompassing all areas of our clients' needs. Expertise and experience. Our advisors, we're skilled with the experience and licenses to provide appropriate advice to our clients, in particular Australians living abroad. And finally, our institutional capability. We have a proven track record of delivering value for our clients throughout the economic cycle. Further this, our size and scale, we have negotiated discounts from many of our service providers, all of which are passed on to our clients. That's it from me. We'll open up to Q&A. I think we might have a few that have come through, have we, Andre?
It's all been answered. So it's, again, thanks for that though, Maddie. Just wrapping up in terms of the actual presentation, that was a really comprehensive look at the different issues one needs to consider before making the move. I think one of the important things that we all agree on is that you need to get the right type of advice to ensure the transition occurs as seamless as possible, as everyone's circumstances is different. Now, Maddie, just as a final point, can you quickly go through the engagement process with Oreana? How does that work if people have, I guess, want to have further conversations of their situation with us?
Yeah, sure. Thanks, Andre. So look, our contact details, everyone should have, but look, essentially the process is we're more than willing to sit down and have an initial consultation with anyone that's interested in having a chat with us. In that conversation, we'll get a full understanding of your finances and your position and obviously your goals, as we mentioned. Following that, we are then able to, I guess, provide what that'll look like from a fee perspective. So you can go away and you'll have everything that you need to know to make a decision on whether to engage with us.
Cool, thank you. Maddie, just one question before we finish, especially relevant to a lot of us here in Hong Kong. The issue of MPFs, what are your thoughts on that and what to consider when you're looking at, I guess, leaving Hong Kong and going back to Oz? Yeah,
thanks. So again, sort of relevant back to what Gav mentioned. So wrapping up your MPF, you can, as most of us are aware, withdraw it when you're permanently departing Hong Kong. It is quite important to start that process as soon as you can. As Gav mentioned, if that's essentially sold and wrapped up and you receive those proceeds while you are an Australian tax resident after you've moved back home, you will be taxed on that, on those proceeds from your MPF. On the other hand, if you have the steps in place early to redeem that prior to repatriating and becoming an Australian tax resident, you should receive those tax-free. So again, it just comes back to making sure that you're speaking to the right people and putting a plan in place before you go back. Cool. Thanks for that, Matt. And might I just add very quickly with regards to the MPF, even if you do face hurdles in getting it within 6 months of you being back to Australian residence, there are strategies that we can apply, including, using superannuation and contributing into that to minimize any tax impact of getting your foreign super back, etc. But as Matt said, it's good for you to have a conversation with us first, so we fully understand your situation, and we can advise on that accordingly. But again, once again, thank you so much for everyone's attendance. Thank you, Matt, for that. That was really valuable for all of us. Thanks, Gavin, for for sharing your experience, and Ian as well, in terms of the currency expertise. So it's been a pleasure for having you all with us. Please don't hesitate to reach out to us, to Maddie or myself, for anything we can assist with, and hope you all have a good evening. Thank you very much.